So again, Dalio, so when he talks about that, he's really talking long term. If anything, if you line up his cash is trash comments with market activity, they tend to be almost counter-cyclical. So, for example, he said cash is trash in like February 2020, which was like right before one of the most rapid crashes we've ever seen in risk assets, where cash would have been the best performing thing for the next quarter. And so you can have these periods where for a couple of quarters or a couple of years where cash is one of the better investments, right? So just because cash loses 5, 6, 7, 8% a year, you can have markets go down 10, 20, 30, 40% in a given year, compared to, depending on what market you're looking at. And so I think it's one of those things that depends on your risk tolerance and time frame. I think cash is going to be a very poor investment throughout the 2020s. I think that the rates are going to stay persistently below the inflation rate for the majority of that decade. But there will be years where cash is probably towards the top of the pile in terms of investment performance, because you can have down years in the equity markets and things like that. I don't know for sure if 2022 is going to be one of those, but I do think that 2022 is likely to be choppier and worse performing than the prior 2 years. Let's say for the S&P 500 and some of these other well-performing indices. I think that's where there's risk. I think with the fiscal pulling back and tightening monetary conditions, having some cash can make sense. In addition, it's important to know that Berkshire Hathaway, his company, is primarily an insurance company. It's a conglomerate. They're in multiple businesses, but at the heart of it is they have some of the largest insurance operations in the world. And so if you look at most insurance balance sheets, they're almost entirely in bonds. So he has a more kind of higher volatility, riskier portfolio than the average insurance company. He's very equity overweight for his industry, which is, I think, an important caveat to keep in mind. He's not necessarily, like, his personal portfolio might not be 30% cash. It's different when you're running an insurance company. So he's rather, balanced, I say, overall. Now, he certainly could deploy capital, but I think his challenge is he's having trouble with some of the valuations out there. For most of those 10 years, the problem was gold got so overvalued in 2011, 2012, compared to the broad money supply, compared to all sorts of things, that it went through a natural bear market. So it's one of those things, if you start the clock at, say, year 2000, gold outperformed the S&P 500 since then. But if you start the clock at 2011 to 2012, during the peak of the bubble that was in, it's been a terrible performer. And so it really depends on time frames. Now, if we zoom in on what happened in 2021, I think the big thing that likely impacted gold was the rise of Bitcoin and some of the other cryptos, because a lot of the money that would have otherwise flown into gold, basically people that want sound money, right? So Bitcoin's got that big Austrian economist sound money community. A lot of that capital, if Bitcoin never existed, it would have flowed into gold. And before, Bitcoin was small enough that it didn't really interfere with gold. But now that Bitcoin reached roughly $1 trillion market cap, if you look at gold's market cap, it's often cited around 12 trillion. But if you just isolate the private investment portion of it, so you take out central bank gold, and then you take out jewelry gold and industrial gold, things like that, even though jewelry has a monetary component, especially in places like India, but let's say you factor that out. You look at actual just private investment gold bars, gold coins, gold ETFs, things like that, that's maybe 4 or 5 trillion. And so when you have the Bitcoin market getting up to $1 trillion and the broad crypto market getting up to 2 or 3 trillion, that starts to rival gold's market cap. So I would say basically gold ran into competition, and basically, the overall pie went up quite a bit, and just that gold's percentage of that pie shrunk. And so gold kind of just chopped along sideways for a year, where you'd otherwise expect that to do pretty well. So I think different investors obviously have very different areas of expertise, very different risk tolerances. I tend to be equity heavy. The equity market tends to be where I feel most comfortable, that I've done the most research, that I like having a lot of my capital in. So I tend to always be equity heavy, and it really comes down to what areas of the equity market I think are attractive. And so, for example, in the past, say, few months, we've had the healthcare sector not performing very well, and partly because there was impending legislation in the United States that could push down drug prices. So that obviously affects American drug makers, but also, a lot of the European and other large drug manufacturers, the United States is their big lucrative market, because we pay more for the same drug than most other countries, kind of just how we've structured things. And so, if that were to passed, especially some of the more, so there's like a spectrum. Some of them are really kind of, sweeping changes. But of course, the ones that can actually possibly get through the Senate are watered down. And so as that's kind of gone through, it's become increasingly clear that if something gets through, it's not going to be transformative. And so I think a lot of those got really cheap, and they're actually pretty attractive here, especially because in a period where markets might not do as well, like 2022 compared to such a strong period in 2020 and 2021, healthcare tends to be a more defensive area. And then you combine that with the fact that valuations are attractive. I do like that quite a bit. I also think some of the consumer staples, some of the energy pipelines, basically some of the lower volatility dividend type plays might be a good place to be for 2022, at least for a part of a portfolio. So that's kind of an area that I'm inclined towards. I think, again, going back to cash, I think having some either inflation protected securities or short-term ones that are they can be used as like cash equivalents, or just outright cash or short-term bonds. I think having some of those is useful because you can rebalance that into any volatility that happens for assets you actually want to own. And again, all it takes is like, say, a negative 10% year for equity markets for cash to outperform, right? So it's not a super high bar, especially after such a strong period. So I wouldn't be all in cash, but I also wouldn't have zero cash. And then really, property is obviously a more personal decision because it's not just an investment, it's also a lifestyle decision. And so that's, it's partially consumption, partially investment. Of course, people then have, they can have second, third, fourth properties. They can go into publicly traded types of properties. I think that is market dependent. So for example, I think in the United States, we still have many zip codes that are not very overvalued in terms of property. I think there are still attractive areas of buying property. Basically, in the United States, a lot of foreign capital comes into our equity market. So our equity market is more expensive than similar companies in other countries, which is not always the case. But in this particular period of time, the equity market is very expensive. Whereas our real estate is kind of the opposite. So Canadian real estate, Australian real estate, many countries in Europe, the real estate is elevated for a similar type of property compared to the United States, especially if you're looking outside of New York and some of the other major areas. I think a lot standards kind of suburban American real estate, while it's not exactly undervalued, it's perhaps less overvalued than some of our equity assets are. So I think it will stay elevated, but probably go down from these numbers. And so depends on what country you're covering. So I cover globally, but my focus is on the United States, and we've had among the developed world some of the largest inflation prints because we expanded our money supply more rapidly than most other countries did in 2020, 2021. And my overall base case is that somewhere either in quarter four, which we're in now, or quarter one of next year, we'll probably see the top of the headline CPI prints, and then we probably will cool off for a period of time. That doesn't mean that we go negative, doesn't mean we go back to normal, but I think some of those issues could begin to subside. We're already seeing, for example, that real estate is kind of topping out, and there's a big component of CPI that is tied to real estate, and that's following that with a lag. And so when that kind of gets topped out, that could cause kind of a cooling off of that headline in CPI at least. In addition, we have money supply not growing as quickly as it did, say the peak of the rate last year. In addition, a big component was used car prices going up dramatically because we've had semiconductor shortages. And so we see signs that there's a lot of inventory for cars at manufacturers. And of course, they just haven't gotten to the dealerships yet because they're waiting on those semiconductors. So whenever that semiconductor issue gets resolved, which is this line, it's going to take a few years, that should be a disinflationary burst for the used car and the new car segment, right? Because you basically have a lot of that kind of stored up inventory coming to market. And so I do think we're going to see gyrations in inflation, kind of like how we already saw a gigantic lumber spike and then that cooled off and then it kind of rose again, while other areas of inflation, mainly the real estate segment, started kind of steadily going up. I think we're going to see rotations like that. But overall, I think that especially with fiscal policy pulling back and monetary policy tightening, I do think that we can start to see a cooling off of headline CPI. Now, Europe is a little bit different because Europe has these energy shortages, which are rather spectacular, and so when they get past those, right? So when you get past the winter months, for example, you start to see kind of again CPI kind of cooling off. maybe with a bit of a lag compared to the United States because their inflation started a little bit later and might end a little bit later. But overall, that's kind of a wild card because those grid and natural gas issues are so